Bull Bear Buzz podcast for decoding markets, fueling minds.
Welcome to the Deep Dive. Today we're unpacking the journey of a company that, well, has pretty much become a household name for getting things done around the house in India and now beyond. Urban Company. You might remember them as Urban Clap.
Yeah, exactly. Founded back in 2014 by Apiraj Bal, Raghav Chandra, and Varun Kaitan.
And their goal was, well, ambitious but needed, right? To bring some structure, some dependability to the home services market in India.
Oh, absolutely. It used to be so fragmented.
Yeah.
Think back like a decade ago. You'd need a plumber, you'd ask around, hope for the best, maybe look through an old directory.
Totally. And you had no real idea about skills, training, or even what a fair price was. It was pretty hit or miss.
Very much so. Lack of transparency was a huge issue.
So Urban Company stepped in to build that bridge. They created this platform connecting you, the customer, with professionals who are, vetted and trained.
And for a massive range of stuff. It's not just plumbing and electrical. We're talking beauty services at home, appliance repairs.
It's huge. Over 50,000 professionals, 12 million customers across, 60 cities in India? Plus they're in Saudi Arabia, Singapore, the UAE now.
The scale is definitely impressive. And they keep adding things, like their own water purifiers, even that Instamaids thing for quick help.
Right, which signals maybe broader ambitions beyond just being an aggregator.
Well, that's interesting because they started as an aggregator, but they've put a lot of emphasis on quality control.
How so?
Through rigorous training programs. They even help pros get tools, loans. It's more than just matching people. They're trying to elevate the whole service standard.
Kind of a win-win then. Better service for customers, more support for the professionals.
That seems to be the model they're aiming for, yeah. Creates a stronger ecosystem.
Okay, so the main reason we're diving deep today is this potential IPO. It's a big deal, not just for them, but for India's startup scene, right? And for anyone interested in how these companies grow and navigate the market.
Definitely. It's a key moment. And to understand that, we should probably look at how they actually make money.
Good point. What are the main revenue streams?
Well, the core is still the commission they take on every transaction booked through the platform.
Like a percentage of the service fee.
Exactly. And that percentage can vary, depending on the service, the city, things like that.
Okay, that's the foundation. But you mentioned they're doing more now.
Yeah. They also earn revenue from fees for, let's call them value-added services for the professionals themselves.
Like the training programs you mentioned, or tech tools.
Precisely. Access to their booking tech, communication tools, those specialized training modules. Those aren't always free for the service partners. It generates income, sure, but it also sort of locks the partners into their system more tightly.
Makes sense. Builds loyalty and improves skills. And the third stream, the product sales.
Right. That's relatively newer but significant. Selling their own branded water purifiers, for example, that's a direct-to-consumer play.
So moving beyond just facilitating services into selling actual things.
Exactly. It opens up a whole new revenue channel and maybe a different kind of customer relationship, too.
Okay, so a mix of commissions, service fees from pros, and now product sales. Now, all this growth, this expansion, it needed fuel. Let's talk funding.
Oh, they've definitely attracted significant investment. It really kicked off in 2015 with a $10 million Series A.
Yeah.
SAIF partners led that, and you had folks like the Snapdeal co-founders, Excel partners involved too.
Strong start. Showed early belief in the model.
Yeah, and that seemed to build momentum. 2016 saw a $25 million Series B, led by Bessemer Venture Partners, with the earlier guys chipping in again.
So investors doubling down.
Seems like it. Then $21 million Series C in 2017, Vi Capital leading that one, again with existing investors participating.
They kept the faith.
It looks that way. 2018, another $50 million for Series D. Steadu Capital came in. Then Tiger Global led a big $75 million Series E round in 2019.
Each round, presumably funding the next stage of growth, more cities, more services.
You'd assume so. And then the really big one, the one that made them a unicorn.
Ah, yes, the unicorn round.
That was 2021. A massive $255 million Series F Prosus Ventures led. But you had Dragoneer, Wellington Management, Tiger, Vi, Steadview all involved. That pushed their valuation over $2 billion.
Wow. And wasn't there something more recent too?
Yeah, July 2024, another $50 million, but that was a secondary transaction with Dharana Capital. So existing shares changing hands mostly.
Okay, so if you tally it all up, Based on tracks and data and reports, it's around, what, $376 million across maybe 12 rounds?
Something in that ballpark, yeah.
Yeah.
Serious amount of capital raised over the years.
Which leads us to performance. How has all that investment translated into actual business results? What are the financials looking like?
Well, the growth is definitely there. Revenue for FY24 hit 827 crore. That's up about 30% from 637 crore in FY23.
And FY23 was up from FY22 too, right?
Yeah, FY22 is around 437.6 crore, so consistent top-line growth.
Okay, revenue's climbing. What about the bottom line? Profitability is the big question mark for many startups heading for IPO.
And they've made real progress there. Losses have come down significantly. FY23 saw a pre-tax loss of 312 crore.
Which sounds like a lot.
It is, but compared to FY24, where it dropped to 93 crore, and FY22 was even higher, like 514 crore loss. So the trend is definitely towards better efficiency.
And haven't they actually tipped into profit recently? I thought I saw headlines.
They have, yes. In Q1 of FY25, they reported a pre-tax profit of 12 crore. Revenue was 281 crore for that quarter.
Okay, positive territory.
And they also mentioned a net profit of 242.3 crore for the first 9 months of 2024. But there's a bit of a catch there.
Oh.
A large chunk of that, about 215 crore, came from a deferred tax credit, which is more of an accounting adjustment, not really operational cash profit.
Okay. So the pre-tax figure is maybe a better indicator of underlying operational health.
Arguably, yes. It shows the business itself is starting to generate profit before taxes and those kinds of adjustments. Still, it's positive movement.
Got it. What about usage metrics? Orders, customers?
Also trending up. FY24 saw an average of 2.2 million orders per month. Average order value was around 1,290.
And the total value of those orders, the GMV?
GMV hit 2,564 crore in FY24. That's 23% growth year on year.
Still solid growth, even if maybe slightly slower than the jump between FY22 and FY23.
Yeah, the previous year's growth was higher, around 38%, but 23% on a larger base is still substantial. They also grew annual transacting consumers by 17% to 5.8 million and active pros by 8% to 46,000 in FY24.
Okay, so growing user base, growing professional network, improving financials. Sounds like the stage is set for the IPO. What's the latest on that plan? We heard initial numbers like 3,000 crore.
Yeah, those are the early reports. But it seems the plan has been revised downward somewhat. The latest buzz is they're looking to raise about 528 crore in fresh capital through the IPO.
Okay, significantly less fresh capital than maybe first thought. Why the change, do you think?
Could be several things. Market conditions are a big factor. Investor appetite for new listings hasn't been super hot consistently. They might be adjusting based on feedback, trying to ensure a smoother listing.
Makes sense. So they're expected to file the DRHP soon. That's a big document, right?
Exactly. The draft red herring prospectus should be filed with SEBI, the regulator, quite soon, maybe within the next month, based on reports from around April 2025. That document will have all the nitty-gritty details for potential investors.
And how do they plan to use this 528 crore in fresh funds?
Well, based on earlier info, which might still hold true, a good chunk, maybe 190 crore, is for platform innovation and tech upgrades. Think AI tools, scaling the back-end infrastructure.
Investing in the core tech.
Right. Then maybe 80 crore for marketing, brand building, digital, outdoor, OTT platforms. Another euro crore or so for lease payments, office expansions, both in India and internationally. The rest for general corporate stuff, working capital, etc.
Okay, focused on tech, growth, and operational needs. What about the offer for sale, the OFS? Initially, that was meant to be quite large, letting early investors cash out.
Yeah, the first plan mentioned a 1,471 crore OFS. That would have been a big exit opportunity for early backers like Excel, Bessemer, Elevation, Tiger, VY Capital.
And potentially huge returns for them, given they got in early.
Oh, absolutely. Someone like Excel probably got in at a much lower price per share than, say, Tiger Global did in later rounds. The returns could be vastly different.
So with the smaller fresh issue, does that mean the OFS size will also shrink?
It's very likely, yeah. We'll need to see the final DRHP to know the exact structure, how much existing investors will actually sell in this IPO.
And who's guiding them through this process? The bankers.
They've got a solid lineup. Kotak Mahindra Capital, Morgan Stanley India, Goldman Sachs India, JM Financial, the usual big names you see in major IPOs.
Right. And there was talk of a pre-IPO placement.
Yeah, possibility of placing shares worth up to maybe 85.8 crore with select investors before the public offering. If that happens, it reduces the amount offered in the main IPO even further.
Okay, so the IPO is moving forward, but maybe more cautiously than initially planned. Now, looking beyond the listing,
What are the big challenges or risks for Urban Company, especially as a public company?
Well, one huge one is navigating the whole regulatory landscape around the gig economy. Labor laws are evolving. There's pressure to provide more benefits or protections for gig workers. That could really impact their costs and model.
That's a global issue, really, but especially relevant for a company relying on 46,000 plus professionals.
Absolutely. Then there's international expansion. Going into the UAE, Saudi Arabia, Singapore is one thing, but scaling further means dealing with very different customer habits, regulations, operational hurdles in each market.
Not easy to just replicate the model everywhere. Definitely not. Competition is another. The home services space is heating up. You've got local players, maybe global ones, eyeing the market. Staying ahead on quality, price, innovation is constant pressure.
And maintaining profitability. We saw they've made progress, but is it sustainable?
That's the key question for investors. Can they keep growing transactions, keep finding efficiencies to deliver consistent profits long term? It's not guaranteed. Their reliance on that large gig workforce is both a strength and a vulnerability.
How so vulnerable?
Well, apart from the regulatory risk, there's managing quality control across such a vast network. Partner churn, professionals leaving the platform can be an issue. Ensuring consistently good service everywhere all the time is tough.
And you mentioned ESOPs, employee stock options.
Yeah, standard practice for startups to attract talent, but it does mean ongoing share-based payment expenses hitting the P&L, and it dilutes existing shareholders over time. Something public market investors watch closely.
Okay, so regulatory shifts, international scaling, competition, sustained profit, managing the gig workforce, dilution. Quite a few things to keep an eye on.
For sure, and just maintaining that service quality as they add more and more service types and expand geographically, that's a core operational challenge.
Right. Let's zoom out again. What does this IPO, even in its potentially revised form, mean for the broader Indian startup ecosystem?
I think it's still a significant positive signal. It's inspirational for other entrepreneurs. Shows you can build a large-scale business by using tech to organize a traditionally messy sector.
And it highlights the impact of the gig economy too, right?
Yep.
Job creation.
Definitely. It's provided opportunities for tens of thousands of service pros. So there's a socioeconomic angle as well.
And for investors, what does this IPO signal in the current climate?
Well, the funding environment has been tighter lately. So seeing a major consumer internet company like Urban Company head for the public markets is a bit of a test case. Its success, or lack thereof, could influence sentiment towards other tech startups thinking about an IPO.
A bellwether, perhaps.
That could be, yeah.
Yeah.
It'll be watched very closely.
And finally, those newer ventures, Instamaids, the water purifiers, smart locks.
Right. Those show they're not just resting on their laurels. They're looking for diversification, adjacent markets, quick commerce with maids, direct-to-consumer products. It's about building more touch points, more revenue streams. How successful those bets are remains to be seen, but it shows ambition.
Okay, so summing up, Urban Company's story is really about tackling a big market gap, using tech, focusing on training, scaling impressively, and now improving financials as they eye the public markets.
Yeah, a compelling journey of growth and innovation in India. But the road ahead isn't without bumps. Regulatory hurdles, competition, proving sustained profitability, managing that huge workforce.
Yeah.
Those are the big questions now.
So the provocative thought for you listening might be, as Urban Company goes public, how will they strike that balance between aggressive growth, maintaining the quality of service you receive, and ensuring the fair treatment and well-being of the thousands of gig workers who power their platform?
That balance is critical. And what does the smaller IPO size really tell us about today's market and how investors view these kinds of tech companies right now? Their performance post-listing could really shape perceptions about the gig economy's future in India.
Absolutely. And on that note, just a very important reminder for everyone listening, the discussion today, all this information, it's purely for educational purposes. It is not financial advice.
That's right. We are not SEBI-registered advisors. Investing in stocks, including IPOs, carries significant risks. You could potentially lose money.
So please, always consult with a qualified SEBI-registered financial advisor before making any investment decisions. We can't be held liable for any losses resulting from decisions made based on this conversation.
And for unbiased market updates and insights, do consider subscribing to Bull Bear Buzz.